Hello from Hong Kong and welcome to this week's market update. Now, it was a wild week in markets. Tech stocks started the week with big falls as inflation worries spooked investors. US consumer price inflation rose at a quicker pace than expected. Now, much of the rise was down to a 10% spike in the cost of pre-owned cars. This is likely a transitory number and caused by supply bottlenecks. Year-on-year comparisons here are unhelpful and they skew to the upside as we're comparing to numbers from the beginning of the pandemic. Price rises as demand returns, coupled with likely price gouging from hotels and airlines as they try to recoup lost revenue, is likely to moderate as we see supply-side risks waning. The next few months, though, are likely to be obsessively focused on inflation numbers, which could adversely affect tech stocks. The MSCI Asian Stock Index entered a correction, falling more than 10% from its recent high. Chinese tech stocks accounted for much of the fall, with steep declines in stocks such as Meituan, JD.com, and Alibaba. The latter reported its first quarterly loss since becoming a public company, this after paying a more than $2 billion fine to Chinese regulators. Alibaba stock is down more than 9.5% so far this week. The value side of the market, now think banks and consumer staples, has continued to outperform. Europe's main indexes are much more value-orientated with very little tech exposure. Now, this continues to filter through analyst calls that European markets should outperform in a market concerned by rising inflation. Europe, of course, has its own demons, long dogged by sluggish economic growth. But on a price-earnings basis, markets like the UK are relatively cheap than most other major markets. Now, the major European indexes are down around 1.5% so far this week compared to the S&P 500, which is down 2.34%. Bullish sentiment on the value side surrounding the travel and leisure sector in particular concerns me slightly. Whilst domestic travel in the US and Europe may surge during the summer, cross-border travel is likely to be messy and expensive, with the requirement to purchase testing packages. Now, in a story this week in the BBC, they reported that London Heathrow, which is already facing lines at the border in excess of 6 hours, is preparing to divert or hold passengers on planes if lines at immigration get any longer than that. Now, one can only imagine the chaos after May 17th when travel restrictions are lifted. Asia is much further behind, with a much slower vaccine rollout, and Airbnb CEO Brian Chesky outlined that demand in the US and UK and Europe has surged, with Asia lagging. Now, Asia's more cautious approach means mass travel is unlikely to return until at least 2022, and Australia this week announced it expects to keep its borders closed until mid-2022. Finally, this week on the positive side, investors on Thursday looked like they started nibbling again at growth stocks. Despite the fraught environment for growth names lately, Wall Street analysts have continued to increase price targets. Now, quality growth names like Apple, which is 15% off its 52-week high and has a 61.9% buy rating with a price target upside of 11.3%. Apple stock was up 1.79% as dip buyers moved in on Thursday. That's all for this week's market update. I'll see you all again next week.